Well, hello everyone. Don Garman here with Lauren Moon. Here again, we are in February of 2023. This is my official opportunity to welcome Lauren back officially, although she's been back for uh, actually very much never fully disappeared, but back from official maternity leave, whatever that means nowadays for women, particularly in this line of work in 2022, which was quite crazy.
Yeah.
I thought this was an opportunity, in addition to welcoming her back, to discuss some of the, interesting, confusing to some, myself included, cross currents here in capital markets so far in 2023. I thought Lauren would be the perfect person to chat with because some of you know, not all of you, but some of you, that Lauren runs a strategy that I would say would be more appropriately designed for people of her generation, which I would say captures more of the innovation and sort of technology forward themes of the market. And to her credit, while some of those themes were being, tortured by some measurements in 2022, very much to Lauren's credit, she stuck to her guns and sort of fought through, and is obviously off to an incredible start here in 2023. So Lauren, I would ask you to just comment on, that was a crazy year in 2022, and
Yeah.
so tell us how it was and how it is. It must feel a lot better right now.
A lot of people know the story just from what we've talked about in our videos, but high level, a lot of these companies, innovative technologies, growth software, some biotech companies got these, have these great business models, but people were paying these super high multiples for them, especially when interest rates were basically at zero. These growth companies are valued off of their future earnings. So when that interest rate is essentially what you're discounting the value at. So when it goes from 0 to close to 5%, the numerator is going from 0 to 5. So the ending value goes down. So essentially, broad strokes, that's what happened to a lot of these companies from a valuation standpoint in 2022. So that was, painful to ride through. We talked a lot about what's priced into the market already versus what's not, when is the right time to buy back in. So it was definitely a struggle in waiting that out. But, throughout the year, we really solidified and increased positions to the companies we were the most optimistic about from even a current cash flow standpoint, to position us well for when things turned around. So this year we've seen, we may be nearing the end of rate hiking, fingers crossed. We don't know when that will change, but for now, the markets seem to be looking past that. So that has driven a lot of, the performance in the month that we've had so far, but it's been exciting to see companies that, have kind of weathered the last year's storm and are still growing and still showing strength and improved metrics from an earnings and cash flow perspective are really getting rewarded and having a really strong bounce back. So it's been.
And I think if I can add to that, I think what we have learned, or at least what I've learned through watching, kind of the last 6 weeks of last year and the first 6 weeks, actually 5 of this year, is clearly understated the amount of tax loss selling and one directional selling pressure that the companies experienced. And just in the absence of that relentless tax loss selling pressure, that dynamic shifted. And, the rubber band gets stretches too far sometimes in both directions. And they just became too cheap.
In conversations with clients, and this is probably our highest risk strategy, if that's safe to say, using your race car analogy, this is full blown.
Yeah, this is rocket fuel.
Even your sports car. This is like NASCAR volatility we've been experiencing.
Yeah.
So,
but I have to give you credit because the temptation. There's two temptations, I think, in your impressive evolution, from sort of niche into I would say, you know, professional other people's asset management. It's hard, right? And that we talked about this going through it. There is a temptation to throw in the towel and to say it's not working or give up. And we have actually seen that happen in other strategies over the, you know, times when things
Mhm.
go out of favor. And, you know, and it's very interesting. People don't add at those
Yeah,
moments. They just don't. We want
yeah,
them to, and but what you did, which I thought was great, is really communicated with people that this was likely to be somewhat temporary and to look through. And to your credit and to theirs, they seem to have done that. So I'm really glad
yeah. Well,
financially that they
it's
did
good.
that.
You know, how we address this with clients is that each of these kinds of strategies have a role to play within a portfolio. So the key with our clients has been for people that want this level of risk, where it's appropriate to have this level of risk, we make sure it's the right size, proportionate wise to their portfolio. But looking back over the last year now, we can see, you know, for example, with the long view, we have a much more comfortable ride through the last 12 months. And things are behaving as they should. You know, the luxuries, we had a much less comfortable ride in 2022, and then the last 5 or 6 weeks have been really fun.
Yeah,
So,
yeah.
you know, you talk about this a lot as we look day to day when we're watching the strategies, is everything behaving the way that it's supposed to? And so, you know, as long as we are consistent in how we're, you know, steering the direction and,
Mhm.
you know, amplitude of the risk that we're taking, um,
Yeah, that's the biggest mistake of all, is that you retune the engine of your NASCAR to minivan speed. And, you know, it's just,
after the
it's a
crash, and
recipe.
then you're never going to win.
It's a
Yeah.
recipe for disaster, and people do it in variety of ways all the time. And so anyway, I just wanted to take a moment and appreciate you for that. It was not easy, and I hope it continues to be as easy as it has been, but as you know, it probably won't be.
Yep.
So let's look out into 2023 with our crystal ball perfectly tuned. And I will admit, since we're chatting and we don't obviously rehearse this, you know, in any robust way or any way, to be totally truthful. So I've been in the earnings must come down a lot camp.
Mhm.
And one of the things that's confounding my own conviction about that is this probably should have been the earnings reporting period. And we intentionally waited to do this video to today to let the big, you know, the five horsemen of the NASDAQ get through reporting, because I
Mhm.
thought this would be the time when they started to hatchet their expectations for the remainder of 2023. In reality, there's been a couple that have actually not only reaffirmed, but there's somewhat of a case now where if unemployment stays this low, maybe chop through and meet their numbers, if not exceed, which
Hmm.
changes the temperature a little bit. So, how do you read the tea leaves?
Uh, how do I read the tea leaves? I think that one argument is obviously that, you know, maybe we're past it. The market's looking past all of this. It's not, the consumer is stronger than we expected. I think the flip side is that we all know about all the layoffs that have been going on. And in the US, at least, the consumer spending is what drives the economy. So it's hard to argue that as these layoffs have happened, that there isn't going to be this pullback in spending. Now, that's where the Fed comes back in, right? So if unemployment doesn't actually increase as much as we think it will the Fed keep rates higher for longer? That negatively impacts valuations, the market, and then, you know, a weaker consumer affects corporate profits as well. So that's
Perhaps
the
yet another
indication.
bullwhip, longer, maybe it's
Another
taking
bullet.
longer
But
than
I
it
mean,
wanted.
you
Yeah.
know how I, you know, not to be overly simplistic, but I also think like we can't possibly predict which way it's going to go. And so our responsibility as advisors is to be aware of these things, to have a viewpoint, but also make sure that in our clients' portfolios that we are still positioned for kind of managed growth and not, you know, we're risk managers also. So
Mhm.
on the downside, but we're not trying to take wild, broad guesses one way or the other.
Yeah. Or put
So
all the chips on one number and no, because we know that's what's going to hit. So we bet it all. And it's not how we,
Right,
it's not how we do
right.
it.
So I think, neither of us are pounding the table, telling people to put all their cash in the market today, right?
Yeah.
So
Yeah.
that's one indicator of how we're looking at things, but we're also not getting more conservative. So we're in a little bit of this, we like our positioning. We think we're well positioned for no matter what happens next, and we'll be adjusting on the margins as we get more information.
Always. Well said. Once again, welcome back, and kudos to you for sticking to your guns and pressing through what I know was a difficult set of months for sure. So I'm going to end this video on a couple little anecdotes. One of them I shared yesterday in our investment committee. I started in the business, roughly 30 years ago, but in my early 20s, there was a family that originally started with my dad. And then as the father passed, the son, who was about 12, 13 years older than me, was one of the sort of first meaningful relationships I had. So think of me at 23 and him at 35 or so. Now I'm 52 and he's approaching 65. So I point that out because we had a review meeting, I think it was yesterday, might have been 2 days ago, but where on the front edge of his retirement, all of the planning that had been done over the years had actually delivered. And they, were in a position where, because of their thoughtful planning and execution, really, and the meetings and the things that have been done between then and now, they're sort of in a perfect position to achieve what they want to achieve for the next part of their life. And so it reminded me of the amazing power of the relationships that we have and get to have with you over not, a month or two. And if we do it right, it's decades, right? And so it truly is a powerful and meaningful relationship to us. And we take the honor of getting to serve you very seriously. The second, I don't even need to go into the second anecdote. It's more of the same. It's just we are consistently reminded, you're sending your friends in, which is amazing. I appreciate that many of you appreciate that we are here and trying to consistently do what we do day after day and week after week and month after month and now year after year after year. It's awesome. And so in many ways, as I always say, we're still getting started, but we're having a blast. So welcome back. How's the family? Lauren, everybody
Great.
doing great?
Everybody's good. Baby is fat and happy and sleeping.
Unreal. So. Well, sleeping's good. That's really what you can ask for at your stage, I think, for that last one. So anyway, any final remarks or?
Nope. I'm happy to be back. I've, reached out, been in touch with clients to touch base, but, as always, don't hesitate to ping us if you want to talk about anything.
Absolutely. Yep. Same here from me. And until next time, we'll see you soon. Thank you. Bye.